Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
Well, today we are diving into the biggest fiscal event of the year, the November 26th budget. And what a chaotic day it was.
It really was. You had the usual political theater, didn't you? All that morning speculation about a milkshake tax of all things.
Right, but the real story, the actual drama, that started hours before the chancellor even stood up.
The leaked OBR assessment.
Exactly. It just landed and set this deeply pessimistic tone for the entire day.
And if you strip away all that Westminster noise, this budget wasn't about small tweaks. It was a massive fiscal consolidation exercise.
Probably the largest medium-term tax rise we've seen in recent history, actually.
We're talking about a structural adjustment that's projected to pull in an extra $30 billion a year by 2030.
And for anyone listening in retail banking, in strategy, risk, or compliance, that reverberates. Oh, massively. It hits household balance sheets, it changes wealth management, and crucially, it puts huge new demands on compliance teams.
The key headlines for banking, they really boil down to a few big shifts. First, the chancellor is taxing assets and investments more to pay for welfare reform.
Second, and this is a big one, a massive expansion of HMRC's digital powers. They want more data, more often.
And third, some really significant structural changes to pensions, to wealth, things like the cap on salary sacrifice and that new high-value council tax surcharge.
Okay, let's unpack this. We should start with the core stability measures and that OBR forecast that everyone was talking about.
The government's goal is, well, aggressively clear. Get borrowing and debt down.
And we know the UK is forecast to consolidate its finances more than any other G7 country between now and 2030.
But that consolidation is starting from a really challenging place. That OBR leak set the tone because it showed just how bad the forecast had become.
It confirmed that borrowing was already on track to be £17 billion higher this year than they thought back in March.
And that wasn't because of a lack of tax revenue. It was higher spending pressure, mostly from local authorities and welfare. The chancellor needed to find serious cash just to stand still.
Which brings us to the famous buffer, the safety net for the fiscal rules.
Right. And the budget policy more than doubles that buffer, taking it up to $21.7 billion.
Which is explicitly designed to field tax and spending plans from, minor economic shocks, to give some certainty.
Now, a $21.7 billion buffer sounds large, doesn't it? But is it genuinely robust enough?
That's the question. Given the global backdrop, persistent energy risks, and the OBR's own downgrade to productivity, does it feel more like a political minimum, just enough to scrape by the rules?
It's a political safety net, yes, but it does signal intent. And you mentioned the key long-term problem there. It's not the deficit, it's the underlying structural issue.
Productivity.
Exactly. The key driver of weaker GDP growth is that downgrade to productivity growth. We're just slower than we thought we'd be in March.
And lower productivity means lower long-term tax receipts. So they have to find the money somewhere else.
That's the link. It forces these aggressive hikes on wealth and assets. And what's fascinating is that while policy decisions actually increase borrowing in the short term, by 2029-30, these tax increases are raising an extra £26 billion.
So it completely offsets the spending.
It makes this an aggressively tax-raising budget structurally. It's re-engineering the tax base away from labor and towards non-labor income.
Right, and here's where it gets really interesting for our wealth management and tax compliance teams.
Yeah.
This explicit shift to taxing assets fairly, as the document puts it.
This is the compliance hot zone. It starts with investment income hikes from April 2026. They're just directly increasing the tax rates.
The dividend tax is going up by 2 percentage points.
Pushing the basic and higher rates up to 10.75% and 35.75%. And you see similar hikes for savings and property income.
But the really tricky change, the operational one, is coming in April 2027.
The change in the order of reliefs.
Right. So income tax reliefs and allowances will now be applied to property, savings, and dividend income after other income. You said this is complex. What's the unintended consequence for banks?
It means re-engineering the logic in automated reporting tools. For any bank handling accounts that feed into self-assessment, this shift in the sequencing of reliefs is a nightmare.
Why is that?
Because it dramatically increases the risk of miscalculating a client's tax liability. You have to wait for confirmation of all other income, like from employment, before you can correctly apply the allowances. It's an IT headache wrapped in a tax rule.
And speaking of headaches for high earners, we have to talk about the salary sacrifice cap for pensions.
A huge policy. The NIC's relief on salary sacrifice into pensions will now be capped at the first £2,000 of contributions. That's from 2029.
The government's line is that 74% of basic rate taxpayers are shielded.
They are. But the impact on corporate benefits platforms is profound.
So how many major corporate clients will now have to completely redesign their benefit portals because of this cap? That needs serious lead time, well before 2029.
Exactly. It forces a total rethink of compensation for high earners. It just reduces the appeal of salary sacrifice for large-scale tax planning.
And moving to property, we saw the new Value Council Tax Surcharge.
Yes, on homes over £2 million. It's being sold as a fairness issue, addressing the fact a bandy home can pay more proportionally than a 10 million property in Westminster.
It's revenue-raising, dressed up as fairness.
Pretty much. And it creates a whole new category of tax risk for anyone managing high-value residential portfolios.
And just before we move on, it's worth a quick mention of the stamp duty reserve tax relief.
Ah, yes, for transfers of a company's securities. It's a targeted measure, really, aimed at making UK listings more attractive.
If you're finding this useful, don't forget to follow Reg Talk UK on Spotify or to subscribe on YouTube. It really helps us reach more compliance professionals like you.
Okay, welcome back. So we've seen how the government is taxing assets. Now let's look at how they plan to enforce compliance and also how that money is being spent.
Because those changes really alter the financial stability and therefore the risk profile of lending customers.
Let's start with what might be the biggest operational change for retail banking, HMRC's new digital powers. This is critical.
The government is going to acquire third-party data more frequently for interest income and for card sales. The mandate kicks in from April 2028.
April 2028 sounds like a long way off, but for the kind of coordination required from banks and payment providers, that clock is ticking very loudly.
The word frequently is key here, isn't it? Does this mean a move away from annual reports towards something more real-time?
It certainly does. HMRC's strategy is clearly moving towards preventative compliance. That means shifting from traditional batch processing to continuous API-integrated data sharing.
That's a seismic shift in IT architecture and data governance.
It is, and the fact they project this will raise an extra $10 billion by 2029 shows just how serious they are about this digital push.
And they're not just going digital. They're also investing £64 million with private debt collection agencies and hiring more of their own debt management staff.
Plus, sharpening the stick against tax advisors who facilitate non-compliance. That starts from April 2026.
Okay, let's shift to welfare and social risk. The budget had some significant reforms here that will impact customer risk profiles for lenders.
A huge overhaul, really, with twin goals. Lifting 450,000 children out of poverty by scrapping the two-child limit in universal credit.
And reforming the sick and disabled benefit system.
And those goals are funded directly by the tax and anti-fraud measures we just discussed, especially the changes to the Motability scheme.
Right. On the benefits reform, the operational assessments, they seem to introduce real income uncertainty for claimants.
They do. The DWP is increasing face-to-face assessments and adding another 122,000 work capability assessments by 2029.
For a banking risk team, that's not just a political headline. A pending assessment means potential loss of income, which directly increases the debt servicing risk for that customer.
And the Motability scheme reforms, as you said, were explicitly designed to fund the UC changes, a very clear transfer of funding.
That measure is said to bring in over £1 billion over 5 years.
Yes, by removing VAT relief on top-up payments for expensive leases and applying insurance premium tax, it's targeting what the government sees as subsidies for luxury cars.
Now, shifting to housing, the new Renters' Rights Act 2025. This has major implications for buy-to-let lenders.
Absolutely. The abolition of Section 21 evictions and allowing tenants to appeal excessive rent increases, that fundamentally alters the risk landscape for landlords.
So abolishing Section 21 shifts the risk from simple tenant insolvency to, well, potential behavioral issues or very long eviction processes.
Exactly. So how quickly do buy-to-let mortgage models need to adjust their assumptions? This directly complicates asset recovery and cash flow for landlords.
Moving quickly to transport, we saw the start of a mileage tax for electric vehicles.
The new Electric Vehicle Excise Duty, or EED, a mileage charge for electric and plug-in hybrid cars from April 2028.
This is the government finally tackling the long-term loss of fuel duty revenue.
It is. The good news is it's supported by another $200 million for charging infrastructure and business rates relief for charge points. So taxing the vehicles, but promoting the infrastructure.
Okay, let's touch on infrastructure financing and the Debt Management Office. How is the DMO funding all this?
Well, their net financing requirement for next year is up. They're funding it through more gilt issuance and treasury bills.
But the significant thing is the compositional shift, isn't it? Major increases in short and medium-dated gilts.
That's right, 15.6 billion more in short-dated and 12.4 billion in medium-dated.
So by tilting issuance towards the short and medium end, is the DMO signaling they expect rates to stabilize or even fall so they can refinance more cheaply later?
That's precisely the read. It shows a preference for managing short-term costs rather than locking in high rates for a long time.
And the green financing program. We know it's raised over $50 billion, but there was a big definition change.
A very notable one. The green financing framework has been updated to include nuclear energy as an eligible policy.
That's a massive signal from the government that they see nuclear as green.
It is, and it potentially opens up new mandates for asset managers and infrastructure funds who were previously constrained by older definitions of green.
Finally, some long-term clarity for the North Sea.
Yes.
The new permanent oil and gas price mechanism. When the current windfall tax ends, this new mechanism kicks in with a 35% rate above certain price thresholds.
Which is the tax certainty that capital-intensive sector has been demanding for years.
Exactly.
So what does this all mean? Let's bring it back and summarize the 3 critical takeaways for our listeners in retail banking.
First, tax base expansion. Expect a major compliance overhaul. The new asset taxes on property, dividends, and savings, plus the NIC's cap on salary sacrifice pensions, means an immediate review of products and tax reporting systems.
Second, HMRC's digital reach. Preparation needs to start now for that April 2028 mandate to supply frequent data on interest income and card sales. This isn't a small job. It's a major IT infrastructure project.
And third, customer stress and housing risk. The combined effect of welfare reforms, especially those work capability assessments, alongside the Renters' Rights Act, fundamentally changes the risk profiles of mass market and buy-to-let customers. Risk models need updating, and quickly.
That's all from us this week. Thanks for listening to Reg Talk UK.
Until next time, stay sharp and stay compliant.